Trying to weigh up the risk to reward ratio is often something that's extremely difficult to do when picking stocks, so stick around to see some factors you should take into consideration when you're choosing what stocks to buy. How's it going, guys? Ryan here with another episode of my Stock Market Basics series, and today we're going to talk about weighing up the risk to reward when choosing stocks. But before we begin, I'd like to mention, if you always watch my videos and you enjoy them, please remember to subscribe and like the videos just to keep up with that content, and plus it helps me out so much. And if you've got any comments, queries or questions, leave them down in the comment section below. Now let's kick off this video about risk to reward ratio, and this is something that is often very hard to do when you're a new investor because you're trying to work out what stocks to pick, how much of the stock you should buy, and the likelihood for that stock to either increase or decrease in value. You want to be looking for the safer sort of options when you're new to the investing scene as opposed to those higher risk areas. And there's a lot of factors that you need to take into consideration to make sure that you make the right decisions here. Before I explain to you some of the factors you need to take into consideration when deciding what size position you should buy in a stock, or if you should buy it at all, I want to explain to you the two key types of stocks you need to look out for. At the safe end of the spectrum, you've got blue chip stocks, and effectively what these are stocks that are well established, relatively stable, and have a consistent cash flow coming in. And as a result, these are generally considered to be low risk stocks, and you can tend to put more money into these ones without really having a large potential of losing too much or any at all. On the other end of the spectrum, which is the high risk side of things, you're looking at the penny stocks or the speculative stocks, which are susceptible to extreme fluctuations in price. They're generally very tight on cash. They don't generally have any sort of cash flow actually coming in. Often they need to raise money or take on debt in order to finance their activities. And generally there's no sort of indication as to whether the company will be successful or not, as anything can really happen, especially at the early stages of a company. And the worst thing you can do is throw your money into a company which is going to go bankrupt. For new investors, I'd tend to stick to the side of the safer stocks, the blue chip stocks, those which you know aren't going to fluctuate too much in value, because regardless of whether you trade or you invest, you're not going to end up losing too much money if you stick to a solid strategy. Whereas if you want to start making the big bucks and start making large percentage gains on your shares, you'd start to move towards the penny stocks or the speculative stocks. But with this added gain, you also get the added risk, and that's when you really need to start taking into consideration the risk to reward ratio, and the amount of stock that you want to buy. So the volume of shares that you purchase, and effectively how much money are you willing to risk if it all goes south. When you're sort of getting into these stocks, you really want to just test the waters. You want your portfolio to mainly consist of those blue chip dividend type paying stocks, so you've still got that capital all safe and tied up in those. And then you only want to put a small portion of money relative to the capital you've invested in the safer stocks into speculative or penny stocks. Now let's talk about some of the key considerations that you need to take into account when weighing up your risk to reward ratio, how much you should buy, and whether or not you should invest in a stock at all. And the first one is, what is the supply versus demand ratio? And this is really important when it takes into consideration the current status of the company, because if you're looking at a company which is extremely early in its life cycle, you want to be able to easily get in and get out of that stock at any given moment, because there could be extreme fluctuations in the share price. So when you're looking at the supply and demand for high risk stocks, you want to be looking where there is low supply and high demand. So effectively there's a significant more amount of buyers than there are sellers, and you could easily sell out of your position when you want to. You also want to consider the position that you're taking in the share itself. So for instance, if you enter a stock which has, let's say, 100 million shares on issue, and let's say you buy 1 million shares, you've effectively just bought 1% of the register, and there might not be the demand there to sell that all in one hit at a certain price point or at all. If you're unable to sell your stocks at a certain value due to having way too many shares in your portfolio of that stock, then you might result in losing a lot of money due to the fact that you can't sell. So if the price was decreasing and there's not lots of people there trying to buy the stock, and let's say you've got 1 million shares worth of the stock and there's only 100,000 buyers at each price point, then effectively you're going to have to drop down to each price point to sell your share at a loss each time. With blue chip stocks, on the other hand, you're generally safer, so you won't really have to consider this factor too much, just given the pure fact that with blue chip stocks there's often lots of people buying it, lots of people selling it, and generally it's quite easy to enter or exit positions. The next thing you want to consider is how much of your current capital are you putting into a stock. So for your blue chip stocks, you can tend to put a lot more of your money in because it's safer and the fluctuations in price won't affect the amount of money you're putting in as severely. Whereas when you're looking at the speculative penny stock type stocks, you want to be putting in only a small portion of your capital so that if it does go south, you won't entirely annihilate your portfolio and as a result lose almost or everything. And this follows on to the next point. How much money are you willing to risk in regards to other financial burdens in your life? Do you have other outstanding debts, outstanding bills, outstanding costs that you need to pay in your life? And as a result, you can't risk that money because it could put you in a very, very bad situation. This is where you need to be really careful because you don't want to end up in a position where you're putting your livelihood at risk. So effectively what you want to do is make sure you've done the research, you know what you're investing in, and you're willing to take on and can take a hit if it does go south on the risk when you're investing in the stock itself. And as I said, that's really where your research comes into play. When you're investing long term, you're generally a lot more likely to be doing research into a stock, and then if you've found something that you think is good over the long term, you're likely to invest more money into it because you can see that a company has a clear future and clear path for growth. Whereas when you're tending to do a bit more trading, you're not as into your research and you're just sort of looking at technical indicators or fundamental catalysts that could result in the price going up or down significantly over a short period of time, and as a result it's probably not worth buying as many of those stocks purely due to the fact that the risk level is significantly higher when it comes to trading and your level of knowledge on the stocks itself. Then moving on to the final point, what is your investment strategy? Are you trying to invest and grow your portfolio long term with safer investments? Are you looking at buying stocks which can generate you significant amounts of money in dividends? Or are you looking for those stocks which are going to go up in value really quickly over a short period of time? You really need to determine what you are doing and set your risk level appropriate to your investing strategy. A great example of this would be you might be putting $20,000 into a blue chip stock and eventually it's going to start paying dividends and it's going to generally increase in value over time. Whereas if you're looking at a more speculative stock where you're trying to trade it, you might only want to put $2,000 in because what you're doing is effectively taking into consideration, can I get in and out of this stock quickly? What's my position sizing? What's my risk level if this starts to go south? And the amount of money I would lose if it would go south. Now, of course, there are a lot of other factors you need to take into consideration when weighing up the risk to reward ratio when you're trying to pick stocks and pick your stock strategy overall, but these I think are some of the key ones you can use as a beginner so that you can get your feet on the ground and start investing and start generating a strategy for growth of your portfolio. Now that's all for today, guys. I hope you enjoyed the video. If you did, please remember to leave me a thumbs up. It helps me out so much, and subscribe to keep up with regular content. And if you've got any comments, questions or queries, leave them down in the comments section below. And with that, I hope you guys have an awesome day. See you next time.